Stop! Before you make your next investment, you need to hear this. These 6 deadly mistakes could destroy your portfolio in 2025. And the worst part? Most investors don't even realize they're making them. Welcome back to the channel. Today, we're breaking down the 6 deadly investing mistakes you absolutely must avoid in 2025. Whether you're just starting out, or you're already a seasoned investor, these pitfalls could set you back years, or even decades if you're not careful. Investing isn't just about picking the right stocks or riding the market waves. So stick around, because by the end of this video, you'll know exactly what these mistakes are. And more importantly, how to avoid them so you can keep more of your hard-earned money. Let's be real. Would you walk into a casino, throw down your life savings on the roulette table and just hope for the best? Of course not. But that's exactly what you're doing when you invest without a clear strategy. Did you know that over 70% of retail investors don't have a written investment plan? That's insane. Without a strategy, you're essentially gambling with your money. Emotional decisions, impulsive buys, riding the hype train, panic selling when the market dips. These are all inevitable without a roadmap. So, how do you create a winning investment strategy? It starts with setting clear, specific, and measurable investment goals. What are you trying to achieve with your investments? Are you saving for retirement, a down payment on a house, your kid's college fund? Next, you need to determine your risk tolerance. How much volatility can you stomach? Are you comfortable with the idea of potentially losing money in the short term for the possibility of higher returns in the long run? Think of your investment strategy as a GPS for your financial journey. Remember, a solid investment strategy isn't static. It evolves as your financial goals and life circumstances change. Don't just copy what your friend, family member, or some random YouTuber is doing. Create a plan that works for you. You know how they say, don't put all your eggs in one basket? Well, it's not just a saying your grandma throws around, it's one of the most fundamental investing rules for a reason. Too many investors concentrate their money in one stock, one sector, or one asset class, because they think they've found the next big thing. But here's the thing, even if you're right, and that stock goes to the moon, you're still exposed to massive risk if you're not diversified. What happens when that one company has a bad quarter, their CEO gets caught in a scandal, or the entire sector takes a nosedive? Your entire portfolio sinks with it. Diversification isn't just about having a bunch of different stocks, it's about strategically balancing your investments across different sectors, regions, and asset types. Historically, diversified portfolios have consistently outperformed concentrated ones over long periods. In the early 2000s, many investors were heavily invested in tech stocks during the dot-com bubble. They thought it was a sure thing that tech stocks could only go up. But when the bubble burst, many of those investors lost significant portions of their wealth because they weren't diversified. Don't let history repeat itself in your portfolio. Have you ever heard the saying, time in the market beats timing the market? It's a phrase you hear thrown around a lot in the investing world. But it's one of those things that's easy to say and really hard to actually do, right? Market timing sounds great in theory. I mean, who wouldn't want to buy low and sell high every single time? But the reality is that even professional traders with years of experience and fancy algorithms struggle to consistently time the market correctly. In fact, missing just the 10 best days in the stock market over the past 20 years could have cut your returns in half. Instead of trying to predict the unpredictable, focus on what you can control, time in the market. A famous study by Charles Schwab revealed that even the worst market timers, the people who consistently bought and sold at the absolute worst possible times, still outperformed those who pulled out of the market entirely and tried to time their re-entry. If you're constantly buying and selling based on the latest news headline, market rumor, or gut feeling, you're not really investing, you're speculating. Remember, patience is often the most profitable investment strategy. Alright, let's talk about something that might seem boring but is crucially important. Fees. Those small, seemingly insignificant fees that your broker charges, they might not seem like much now, but over time, they can eat away at your profits like termites, silently chipping away at your returns year after year. Let me give you a real-world example. Let's say you have a $100,000 investment portfolio, and you're paying a 1% annual fee. Doesn't sound like much, right? Well, over 20 years, that 1% fee could cost you over $28,000 in lost returns. Always, and I mean always, check the management fees, transaction costs, and expense ratios before you invest in anything. Index funds and ETFs, for example, are known for having much lower fees than actively managed funds. If two investors start with the same $100,000 and one pays 1% in fees while the other pays 0.2%, the second investor could end up with tens of thousands more over a few decades just by paying attention to fees. So, do your due diligence, shop around for the lowest fees, and keep more of your hard-earned money working for you. Let's be honest, investing can be an emotional roller coaster. 1 minute the market is up, the next minute it's down, and it can be tempting to make impulsive decisions based on how you're feeling at any given moment. But here's the thing, fear and greed are two of the most powerful and dangerous emotions in investing. Ever panicked sold a stock because the market took a dip, only to watch it rebound shortly after? Or how about this? Ever jumped on a hyped-up stock because everyone was talking about it only to watch it crash and burn a few weeks later? Yeah, we've all been there. Successful investing requires discipline, patience, and most importantly, emotional control. Studies have shown that emotional investing, making decisions based on fear or greed rather than logic and strategy, accounts for nearly 50% of underperformance among retail investors. So how do you avoid falling into the trap of emotional investing? Here's a tip. Before making any major investment decision, take a step back, take a deep breath, and ask yourself if it's driven by fear, greed, or logic. Remember, slow and steady wins the race. The world of finance is constantly evolving. New trends emerge, technologies disrupt industries, markets shift, and the only way to stay ahead of the curve is to be a lifelong learner. If you're not constantly learning, growing, and adapting, you're falling behind. Make it a habit to read books, follow trusted finance channels like this one, listen to podcasts, attend webinars, whatever it takes to stay informed about the latest market trends, investment strategies, and financial news. Did you know that Warren Buffett, one of the most successful investors of all time, still spends 80% of his day reading? If it's good enough for Warren Buffett, it's good enough for me. The more you learn, the more you earn. Investing isn't a set it and forget it kind of thing. You can't just pick some investments, stuff them under your mattress and hope for the best. Market conditions change, your life circumstances evolve, your goals might shift, and your portfolio needs to reflect those changes. That's why it's crucial to regularly review and rebalance your portfolio to make sure it's still aligned with your goals and risk tolerance. I recommend setting a quarterly or annual calendar reminder to sit down and really analyze your investments. Regular portfolio reviews are like checking in with your coach along the way to make sure you're still on track to cross that finish line. Alright, let's recap the 6 deadly investing mistakes that you need to avoid if you want to achieve your financial goals. 1. Investing without a strategy. Don't gamble with your money. 2. Lack of diversification. Don't put all your eggs in one basket. 3. Trying to time the market. Don't be a fortune teller. 4. Ignoring fees. Those pesky fees can cost you a fortune. 5. Emotional decisions. Don't let fear and greed control your portfolio. 6. Neglecting continuous learning. Don't get left behind. And a bonus mistake. Failing to review your portfolio. Don't set it and forget it. Avoiding these mistakes isn't just about saving money. It's about securing your financial future, building wealth over the long term, and achieving your financial dreams. If you found value in this video, hit that like button, subscribe for more investing insights, and drop a comment below. Which of these mistakes have you struggled with the most? Let's start a conversation. Stay smart, stay invested, and I'll see you in the next video.